Hi there, it is Dan Kerr's DK Analytics. Thanks a lot for tuning in. We're coming to you again from Zurich, Switzerland, and that is from a canton of Zurich, a little bucolic town called Niederweningen. We want to give you an update, a strategic update. But before we do that, I should mention that it is July 27th, 2018. We want to let you know what you've already read. That is that US GDP growth came in at a stout 4.1%. We're going to have a quick detour before we get into an associated strategic issue and tell you that we think this is quite an unsustainable GDP growth print number, because it's on the back of consumer spending strength, over 4%, an annualized level, and that juxtaposed against the consumer, which has record debt and near record low savings, does not exactly spell a sustainable consumer spending based economic growth recovery or acceleration. This is even more true if one considers the labor force participation rate and the type of jobs that people have been getting for years and years. It is extending into the Trump presidency. I know this both from a local level, and also I know it based upon the degree to which both consumer debt and consumer savings. Consumer debt has risen to an all-time high. Consumer savings have continued to be plundered. If we were producing good, solid jobs with good wages and benefits, we wouldn't have this situation. And of course, we also continue to have Obamacare to blame. But whatever it is, it's not a sustainable consumer spending base recovery. And that drove this quarter. Also, a strong contributory factor in the Q2 4.1% US GDP growth number was export strength, which contributed about a quarter of this growth in GDP on an annualized basis. And that in turn was materially based upon export strength related to fear of retaliatory tariffs that other countries are going or will impose if this trade war gets out of control or in the process of imposing on U.S. products. So that, and led by soybeans in terms of what the original numbers look like. But the point is, if foreign countries are raising imports of U.S. products prior to their own governments doing tit-for-tat tariffs on U.S. exports, just like exports from their countries into the U.S. Are getting hit selectively, then that is a one-time thing, not to be repeated, meaning there's no secular driver for this. So that too is highly suspect, and in fact it could reverse, as could the consumer number, which, given the overall weakness in the consumer's income and his debt and his drained savings, doesn't sound to me like it's going to have legs to it. All right. So enough on that. I wanted to preface my more strategic remarks related to a post mid-month that I called, "If QT keeps ramping up to 600 billion, look for an accelerated reset." What's a reset? It's a huge downward revaluation of stocks, bonds, real estate, and I would argue the dollar, and a massive upward revaluation at some point of precious metals, which are the safe haven asset at the end of the day, always have been and will be recognized as such, which will also be positively impacted by the very thinness of the market and the very small portfolio exposure around the world, less than 0.5%, and obviously the scarcity of it. All right. So as trust in fiat regimes and fiat based investments are, especially bonds, to a degree, a material degree, especially for non-real or resource companies, stocks, right, where you have a lot of goodwill and other things instead of tangible assets. So I think, given what's ahead here in terms of increasing economic weakness, as we really haven't been able to get out from under a broadly toxic public policy stew, and might even get nicked by a trade war. And if all that doesn't happen, recessions are always part of the mix. They haven't been made illegal. They're a fact of life, and we're overdue for one. And we've had a very lethargic and artificial recovery. If we used real inflation rates instead of those concocted by the government, we arguably would have never gotten out of our last recession, as manufacturing statistics clearly suggest. So let's take a look at the actual numbers here and recall the headline here, what really I think is going to set the ball rolling in terms of a reset, if you will, the straw that might break the camel's back, all right, is a Fed, if it carries forward both its interest rate increase and its quantitative tightening, that is, sales of its bonds or bonds it has on its extremely bloated balance sheet of up to $600 billion a year. Bonds are supply and demand like anything else, and what we're talking about here specifically is a widening supply of bonds and how that might spell trouble for the Fed's ability, either politically or financially, to carry forward its balance sheet reduction scheme. If one takes a look at the increase in US federal government debt over the past year through, I think, the first week of July, and one doesn't take the government's word for it, you know, at a fiscal level, this is just on a year-over-year level. It's pretty much indicative in any case of where we are in terms of deficit that's expanding. This has been mentioned, but it's actually quite a bit worse than what the headlines have said. If we take a look at the increase in US federal government debt, you go to the Treasury Department website, got lots of statistics here for you to and links, via links that you can go see by just clicking on them, what I mentioned in the post, in post 42. There's an increase in U.S. federal debt of $1.4 trillion within 1 year through early July 2018. It's the result of weakness in receipts, part of it through the tax reductions, and it's also a large increase in expenditures, which if anything point to a weaker economy, not a stronger one. And that obviously has been abetted or made worse or worsened by the sizable increase in government spending, the bill that Trump signed, which became legislation. And if we enter a full-fledged recession that even the government statisticians can't hide, then we're going to be looking at increased weakness in receipts and even more expanded spending for transfer payments, welfare, jobless benefits, and the like that go hand in hand with a recession, an official recession. In fact, if the last recession, the last recorded recession, official recession in 08, 09 is looked at, we saw in that recession a $1.3 trillion expansion excuse me, in the size of that deficit in an era where we had higher labor force participation rate, better jobs, less malinvestments, less property right dilution, higher productivity, much lower debt, all right? This time around, and we also were faced with a situation where bonds were the go-to safe havens, right? And this time around, we might have not only a corporate, but we might have a solvency issue with the governments themselves, starting with the US and extending across the world. But as we all know, governments can print money, but the Fed is insisting upon doing the opposite, and that's the fly in the ointment. Not that it shouldn't reduce its balance sheet and get out of the way and get back to real interest rates that encourage people to save instead of printing the money and causing all these distortions and cronyism and allowing for redistributionism beyond tax receipts. But such a policy would, given the issues we have, as just mentioned, cause the economy to tip over even faster. And that's our point. Let's take a closer look. If the federal government, if Washington, D.C., had to all of a sudden finance deficits of 2.6 or 2.7 trillion, the current run rate deficit, coupled with the expansion in the deficit during the last recession of 1.3 trillion, so 1.4, 1.3 gets your round numbers 2.7 trillion. That would be an unprecedented amount of federal government financing or bonds that would be thrown onto the marketplace, right? And that would be combined with refinancing needs given the weighted maturity schedule of U.S. government debt of about 3.6 trillion that needs to be refinanced. But let me make it even more daunting in terms of all the supply that the market would have to digest. Meaning, if something is in great supply, to move it, you have to lower the price. And in terms of capital, the cost of capital, as measured by the 10-year Treasury as the benchmark interest rate for so many things, not just the federal government, but by extension, a large degree of the financing in the U.S. is tied to it, to a lesser degree to the 30-year and also to some degree to the LIBOR, but let's focus on the 10-year Treasury, or what I'm going to call the benchmark. If one goes beyond just the U.S. government with 21 trillion in debt and looks at the entire U.S. debt landscape, which is 69 trillion in debt, or very close, that's about 3.4 times GDP, up massively in both absolute terms and in percentage GDP over the last decade, just mushroomed, up, I believe, something like $14 trillion. If one looks at the aggregate total U.S. debt, federal, state, local, corporate, household/individual debt, and one takes that as the true debt, which will have to be both refinanced and, if we could carry forward an expansion of the last 12 months of $2.6 trillion in aggregate U.S. debt, then with a maturity schedule that is roughly similar, or that's a bit of a leap of faith here, to that of the U.S. government, say roughly 6 years, then roughly $12 trillion per annum at all else. And assuming the U.S. government deficit doesn't go up by 1.3 or 1.3 trillion like in the last recession, we're looking at about $12 trillion that has to be refinanced, right? And we're looking at annually, in a best case scenario, I would argue 2.6 trillion in new debt. Now, if we take and move the U.S. government financing cost up by 100 basis points, in terms of the Treasury yield from 2.9 to 3.9, right? It's currently about 2.9%, up from 1.4, 1.5 about 2 years ago. So it's already more than doubled, but I don't think we've seen anything yet, frankly, given both solvency and monetary debasement issues. And sovereigns are broke, right? It isn't limited to the private sector. The governments this time around are broke. Big difference, right? So we could see with this avalanche of supply, again, bonds, if there's too much, you have to lower their price. How do you lower their price? You increase the yields. Let's say we just had a 100 basis point increase in 10-year Treasury, that benchmark rate, right? And we said we have to refinance 12 trillion across the entire debt structure of the U.S. Economy. But we didn't have just a 100 basis point increase in the 10-year. We had roughly 1.5 times that, possibly even 2. Let's use 1.5 times. We've got about 2/3 of the total debt in the U.S. is not U.S. federal debt. But if we take that and do a back of the envelope calculation that the refinancing of all U.S. debt, roughly $12 trillion a year, is going to cost with just with a 100 basis point increase in the U.S. Treasury, i.e. the yield on the 10-year goes up by 100 basis points or 1 percentage point, then we're looking at roughly $180 billion in additional U.S. financing costs. Now, if we add to that roughly $2.6 trillion in new debt, that is what we did last year, without an additional 1.3 to 1.4 trillion in new debt or a deficit as we saw in 08 or 09. It could be a lot worse this time around for the reasons mentioned. Then the refinancing plus the new debt financing in the entire U.S. economy, we are looking at roughly $290 billion per annum of additional interest expense. And that is if the new debt stayed the same and we rolled over or refinanced about 1/6 of all the debt each year. So that's an annual nearly $300 billion increase in U.S. interest expense, just assuming a one-time 100 basis point increase in the benchmark interest rate, the 10-year Treasury as measured by its yield, right? Going from 2.9 to 3.9, multiplying that times 1.5, we get an average borrowing rate for the entire debt landscape that will bring us nearly $300 trillion in annual additional interest expense per annum on top of each other, with a 100 basis point, 1 percentage point increase in the U.S. government cost of financing as measured by the benchmark rate. Now, if we, for the sake of exercise here, and before I go there, let me say this. I've said many times, we don't have reversion to the mean. Whether in stocks or bonds or real estate, we have reversion beyond the mean. Meaning we go from boom to bust. We're in boom. Bonds are ridiculously overpriced. Stocks are ridiculously overpriced. Bonds in terms of returns, real returns, are negative. In terms of solvency issues, okay, the U.S. government won't go broke, but it'll debase its currency by printing to pay what's due. Alan Greenspan has said this quite often. It's in post 41, and you could find it elsewhere. You can't guarantee the value of the maintenance of purchasing power, but he can make you whole. It's just going to be at a fraction of the purchasing power. So we're in a place where reversion beyond the mean on the 10-year Treasury, this is what I want to drive home, and this also is in post 42, is 4.6 percentage point yield on the 10-year. Over a longer period of time, that's the average, all right? If we went to 4.6%, again, assuming 2/3 of all U.S. debt is non-U.S. federal government debt, meaning that would bring with it about 180 basis point increase from today's Treasury yield at 2.8, 2.9%. But we'd have to do about 1.5 times that conservatively, as 2/3 of the debt is non-U.S. government, and we easily have premiums to the U.S. Treasury of 100, 150, 200 basis points, all right? So a 4.6% benchmark, a return just to that, and staying there, would, by extension, using the same logic, the same math, bring a nearly $500 billion annual increase in the cost of U.S. financing year after year. So in 2 years, without going above 4.6%, across the board, all levels of debt, we'd be looking at $1 trillion higher interest expense for the United States within 2 years if a U.S. Treasury bond moved back to its historical average yield of 4.6%. And again, we're not going to go back to the mean or the average. We're going to overshoot or undershoot. In this case, I think we're going to go to 8, 9, 10%, right? But that gives you a flavor of what's at stake. And by the way, $1 trillion is roughly 5% of GDP. Talk about a hit to an interest rate sensitive economy. That is massive. That is recessionary in its implication beyond all the other things. And this is exactly where I'm going with this whole questionable QT bond sales unwinding its $4 trillion balance sheet, the Federal Reserve, and doing that in the face of what is likely to be record amounts of bonds hitting the marketplace, US dollar bonds. In a time when there is increasing distrust, whether it's solvency, whether it's monetary debasement, not only in the US but around the world, which the Fed currently is trying to nip in the bud but won't be able to because its QT will just add even more supply to an oversupplied market. A market that has never faced this kind of US supply hitting it, whether it's new debt or refinancing. And this in a day and age when numerous countries are trying to move away from the dollar in terms of global trade. So go figure. So this brings me back to this supply glut, overwhelming demand. This is going to lead by itself to higher interest rates. This can feed upon itself. And the Fed is going to get very cold feet very quickly for political reasons, for financial reasons, for economic reasons. They're all kind of tied at the hip, and they are not to be separated from each other. And the Fed, as we all know, all central banks are very political at the end of the day, and they're there to protect the balance sheets of their member banks. That's the first and most important mission of the Federal Reserve. So if this policy of trying to take away the punch bowl while still having a toxic public policy stew in place, whether it's all the misallocations, whether it's green cronyism, whether it's redistributionism, whether it's the malinvestments and the resulting dropping productivity growth rate or into a negative number possibly, you're not bringing back and a government, and most importantly, it keeps spending more and more and more instead of less and less and less, and increasing its chokehold on the U.S. economy instead of eradicating these bureaucracies. We're in fact going to expand them, despite what the Donald is saying. So with this as a backdrop, once this comes apart at the seams, meaning, back to the title, if QT keeps ramping up in the face of exploding deficits and financing needs of the entire U.S. economy, well, especially the government, and possibly also the corporate sector, where we more than doubled the debt, and there's more junk out there than ever, you've got lots of potential straws that could break the camel's back here. And the Fed will come in, and if it makes good on its promise and keeps raising interest rates, in the midst of our toxic public policy stew that has metastasized through the whole economy, then I can assure you that they're going to lose control. And that in turn will bring with it, and this is really the strategic bottom line, when the Fed has to do an about face on QT, and it has to stop raising interest rates, and it has to, then what's the conclusion? This whole Frankenstein Finance, which has led to all these misallocations and property right thefts and all these other things that take away the free market capitalist invisible hand of Adam Smith price discovery mechanism, which brings the most people the best results. This will then prove that Frankenstein Finance, the whole financial repression scheme of the U.S. and the world, did not work, and that the only way to fix things, quote unquote, is to give the patient this bludgeoned economy more cocaine, like one of the federal board members said. In other words, print money to to bring the patient back onto its feet. And when that comes and QT goes, well, we go from QT back to QE, and I'm going to argue it's going to be record amounts, not just in the US, but around the world. That's when people will know that this has been a fool's errand for the average person, for the free market, for productivity, for sustainable economic growth, right? And that juncture, and it's not a question of if, it's only a question of when. And I think the Fed going out and carrying forward its 600 billion annualized bond sales program, which it appears to be serious about, is going to bring out this repricing, this reset sooner rather than later. Sooner rather than later. What do I mean by that? It could be this year still. It could be early next year. I'm not sure. But if they insist on throwing an additional 600 billion into a market that's going to be oversupplied with bonds, they're going to guarantee the very interest rates that will sink an overly indebted, unproductive, misallocated economy, which will then bring about more of the same, which then will finally, belatedly be recognized as not only a fool's errand, but the true policy that they have is monetary debasement. And that, in turn, will make people reprice dollar and all paper-based assets, especially bonds, and by extension stocks, because the two are tied at the hip. Read post 24 or 25, if you will. I do a big write-up on it. And that, in turn, will push people for capital preservation, for risk insurance, into precious metals, into physical, not paper holdings, which are extremely limited, and investors are so underinvested in, less than 0.5% of global portfolios, as they have never been since this has been recorded. So that is my message to you. I hope it makes some sense. Encourage you to take a look at post 42. This is Dan Kurz of DK Analytics. Another video from Switzerland. It is July 27th, 2018. Thank you very much for listening. I'm going to go out and see if I can see this lunar eclipse here. That's supposed to be a big deal. Bye-bye.